Hey everybody, one of the business segment of American Express was field warehousing business, in which it would issue authenticity receipts of various assets for its customers. The customers can use these receipts as a collateral to borrow money from banks, and banks would happily accept these receipts because of the highly reputable name of American Express. In 1963, one of the American Express's customer, who goes by the name Allied Crude Vegetable Oil Refining Company, defaulted. American Express had issued inventory receipts for this company by inspecting their several large storage tanks filled with vegetable oil. In order to recover their money, banks had seized Allied's storage tanks. Turns out the storage tanks, which were supposed to be filled with valuable vegetable oil, is rather filled with cheap seawater. With Allied company going bankrupt, all the liabilities came upon American Express. With news coming out that American Express now faces unknown and enormously potential liability, its share price got hammered down from $60 a share to $35 a share within a few months. That is when Warren Buffett, an unknown investor at that time, started buying the shares of this company. Warren Buffett was buying when everyone else was staying away. Turns out, couple of years later, the share price has rose to $90 a share, providing a return of 120%. The question is, why was Warren Buffett buying when others were not? What did Warren Buffett see in this stock? The answer lies in the business model of American Express, and to understand it, let's deep dive into it. For the 10 years from 1954 to 1963, American Express's revenue grew from $37 million to $100 million. That's a growth of 12% per annum on a compounded basis. Now, just for reference, if the economy is growing at 5 to 6% per year, the growth of 12% per year for a company is very impressive. Net earnings grew from $4.5 million to $11 million, which is roughly at the same pace as that of revenue. This shows the company had outstanding growth. In order to appreciate these financial numbers more, we need to look at the operating business behind them. American Express during those times had 10 different business segments, from traveler's check, credit card, money orders to field warehousing business. Let's first discuss the largest and most profitable of them, the traveler's check business. Today, for us, check may be an outdated thing as we have moved on to UPI and digital payments, but check was among few of the alternatives available to cash during those times. Now imagine how would you feel when you have to carry bundles of cash while you are traveling abroad in order to exchange it with foreign currency at your destination. It would be very risky and inconvenient, right? So the traveler's check was the solution. Companies like American Express would sell you paper checks for your desired amount by collecting the cash from you beforehand and a small fee. You can take this check, fly into other countries and trade it with foreign currencies at your destination. Now it's so much easier to travel and not to worry about exchanging foreign currencies. American Express was the leader in this business. It has developed a very large scale international distribution system for travelers' check. Customers can easily find out such centers in many different countries. Also, American Express had developed such a high brand name and reputation that foreign companies would accept these checks without any question. The main alternative to the traveler's check was the letter of credit, which was issued by the banks. But the traveler's check was offering very high advantage over it, such as it involved very less paperwork, it was easier to process, and it took much less time. Traveler's check was offering such a high advantage over letter of credit that even banks started selling it to reduce their burden of issuing letter of credit. So by providing great service to its customers, building large distribution system and brand value, American Express had built a wonderful business around traveler's check which was growing and had significant advantage over its competitors. In order to confirm this qualitative aspect with the quantitative aspects, let's check the numbers. The outstanding traveler's check increased from $260 million in 1954 to $470 million in 1963. This 7% per annum compounded growth confirms the quality of business. Now that it had already built a robust business in the traveler's check segment, it started leveraging its brand name and distribution system, and it expanded into different businesses like money orders, credit cards, and commercial banking. So we can conclude American Express possesses a competitive advantage which is coming from the concept known as the network effect. Network effect is a phenomenon when the value the customer derives from service increases as more people start using it. Think of social media as an example. The app initially is not very useful to you as your friends are not in there, but as more of your friends join, the same app becomes more useful to you. Similarly, as American Express gets more customers, it can spend more in building its brand and distribution system, which in turn will attract more customers, and it becomes a cycle. Now that we have come to the conclusion that American Express is a wonderful business with sustainable long-term growth, let's support this conclusion with the financial numbers of the company. We have already looked at the income statement wherein in 1963 it had earned $11 million on $100 million of revenue. For the balance sheet, the asset side of the balance sheet contains $263 million in cash and cash equivalent, some $500 million in investment securities, $186 million in loans, some $40 million in US Treasury bonds, and some $24 million in properties. The liability side contains $470 million of traveler's check, $366 million of customer deposits and some other liabilities, and $78 million of shareholders' equity. Two insights can be derived from this balance sheet. First, majority of American Express's assets are funded by the customers. Property is just 2% of total assets, which means company does not need upfront capital in order to grow its business. Second, business is generating a very high return on its capital, which is in upwards of 60%. Such high returns when compared with the safer options like US Treasury bonds, which has a yield of 5 to 6%, indicates a very high quality business. Now that we have looked into the business model, let's summarize it into the few points. First, the return on capital of the business is massive. Second, American Express has created a huge entry barriers for its customers. Third, the growth opportunities are huge. And fourth, growth doesn't require reinvestment of earnings back into the business. All these points suggest that American Express is a very good business for investment. But the question still is, why did Warren Buffett invested in this company when everyone else was expecting the company to go bankrupt because of unknown and potentially enormous liability? The answer lies in the 2 points that Warren Buffett saw and others ignored. First point is, while everyone was panicking from the unknown and potentially enormous liability, Warren Buffett consulted its management about it. Management even wrote in that year's annual report that the net liability is estimated to be just under $40 million, which is much less than the expected $150 million. So while everyone else was panicking, Warren Buffett did his due diligence to look at the sustainability of the business and came to the conclusion that it would not be difficult for this company to pay a one-time fee of $40 million to rectify its mistake. Second point is the reported net earnings of the company does not include the earnings coming from the appreciation of its investment securities. It is because the accounting standards doesn't allow the company to do so. But from economics point of view, these earnings are real and sustainable in the long run. So Warren Buffett estimated these earnings, and when he calculated the PE ratio with the new adjusted earnings, it came to be around 11x, which is a bargain price for such a high quality business. So after paying close attention to these 2 points, Warren Buffett put 40% of his partnership fund into this stock, and he was rewarded handsomely as stock doubled in the next couple of years, and this is how Warren Buffett created his first fortune. Now people, there are 3 important lessons for us to be learned from this case study. Number 1, focus on high quality business to ensure long-term compounding results. High quality business approach minimizes risks and avoids speculation. Number 2, buy these high quality businesses at fair price. Many a times we think buying these high quality businesses at any price is going to make us money. It doesn't. Buying at a fair price matters. Number 3, when you get a fair price for such a high quality business, load up the truck. That means don't just put 2 or 3% of your portfolio into such stocks. Put a substantial portion of your portfolio into it. So the next time you come across a crisis on any company, don't rush. Pause and run a few simple filters. Is the business fundamentally strong? Is the price reacting to the news? Do I understand it well enough to size like an owner? Those are the real takeaways from this case study. That's all from my side, and I hope you have learned something very valuable from this case study. If you have learned something valuable, please hit the like button and please subscribe to this channel for more such case studies. Thank you so much for watching. I'll see you in the next video.